Hi, everyone. Thanks for tuning in to another episode of Our 2 Cents on Your Dollars. I'm James Enriquez.
I'm James Credo.
I'm Leo Chang.
I'm Alexis Villarreal.
And today we're going to be talking about, is life insurance an investment? Stop me if you've ever heard this one. Bank on yourself. Be your own bank.
Be your own bank. Classic one.
Just put the money in. You can take it out later.
Yeah. Okay. By the way, what are we talking about? What is that? What does that mean when we say be your own bank? How are these finfluencers using that?
Oh,
yeah, that's right.
These TikTokers.
Yeah. If we're looking at it from a life insurance perspective, what they're saying is utilizing money that you're putting into your policy that you can borrow against and provide some capital and funding for yourself. That's the concept behind being your own bank.
Well, what can I use that capital for? Go buy Skittles?
RV homes when you're in your 60s, 65, vacation rentals. There's some different things that I've heard people say that they're going to use it for. As far as what actually people do use it for, I don't know, right? I've never really had anybody get to that far. Most of the time there's something that happens where they'll need cash or they'll have some sort of circumstance where it kind of changes along the way, right? So in theory, it sounds great, right? I've just never had anybody get from point A to point B.
Okay, so let's back up before we start losing too many people.
Gloss.
They're gone.
Okay.
So
See you guys next episode.
let's chalk this one up.
Did you say life insurance?
It's DOA.
Skip.
Okay, so I opened it up talking about, is life insurance an investment? I said that because that's what people position it as, right? They frame it as such. That, hey, buy this life insurance policy. You can use it to fund your retirement, for college. You can use it for college. You can use it for just about anything. And I think the pitch is also that it's tax-free, right? Something or another.
Yeah, the tax benefits behind it. Yeah.
Okay, so how does all that work? Are those even accurate statements? Can you use it for those things? Should you use it for those things? Discuss.
Can you? You could. I think it's understanding the intricacies behind the type of insurance as well too. And I guess we can kind of go there because first, there are different types of life insurance, right? You have your traditional term policies that don't produce cash value. These are blanketed, insurance products that cover you for a certain period of time, have a fixed death benefit for the most part. You pay a fixed premium, and they're relatively inexpensive. No cash value grows in the policy.
I want to interrupt you there. So
Sure.
Wait, cash value. So what is that? Like when these finfluencers are talking about using life insurance, do they mean I have a $500,000 term policy, I can use the $500,000 to fund my retirement?
So what they're mainly focus on in making those recommendations is the cash value that builds up inside these policies. So in permanent policies, you have really two working parts. You have your death benefit, right? So that's the actual insurance. That's how much you're being covered for, and there's a cost to that insurance that they're providing you for when you die. The other part is the cash value, which is an account that builds up over time. Part of your premium goes to this, we call them sub-accounts. And what happens is that money can grow in different formats depending on the type of policy, and build up like an investment inside the insurance policy over time. And that cash value is flexible.
To add to that point, though, is that in the early years, you really don't have access to be able to borrow from these policies because there are limitations in regards to if you take money out, they'll charge you surrender policy. There's some different charges that occur early on in the year, so you need to be very, aware of when they're actually talking about borrowing. Right, it's typically somewhere later in the future, not in the first 10 years. So so that whole being your own bank isn't really designed for the early part of the years.
Man, you guys sound like haters. So this is a
Bash session.
This is a policy. You have a death benefit. You can grow the cash value. You can use it for anything. It sounds pretty awesome. But why isn't it that awesome?
I think there's a lot of things, right? I think first of all, right, it's a life insurance product, right? And so in life insurance, right, you're going to have a mortality expense. And so there's some costs that come along with that. And so, you are trying to grow your cash, right, which is part of the premise of being able to be your own bank and be able to borrow against. However, there's some expenses that occur, right? So that's going to reduce your returns. And on top of the mortality expense, you also have these different sub-accounts that Leo mentioned, right? And so inside of there are different investments. Inside of those different investments, you're going to have different costs associated with them. So more higher risk positions are going to cost a little bit more compared to your fixed accounts that are sometimes inside of these that will have lower expenses. And so you got to be very mindful of what the makeup is inside of these products.
Man, I'm with James, man. Y'all are just hating. Okay, so then
Hate is gonna hate, baby.
that's right. Then if those sub accounts are more expensive, then I'll get a whole life policy instead.
Yeah, so whole life policies are definitely useful for fixed interest rates, right? So, I guess going to some of the different types of permanent policies that are out there, there are whole life policies, as James just mentioned, which are going to be some sort of guaranteed fixed interest rate on the policy. And so an individual that is putting money into a life insurance policy with such of these, their cash value is going to grow based off of whatever determined interest rate is at that contract point in time. And it's not going to have any impact in regards to stock market volatility. So whatever the rate is, that's what the rate of the policy is. That cash value is going to grow over the period of time. Very conservative policy, something that you would want to utilize for offloading that risk, right? Not wanting to be in the stock market, you'd want to use something like that. Then you have variable universal life, which is a policy to where the sub-accounts are going to be invested in stock market type of funds, and the cash value is going to go up and down in accordance with the stock market. And so as the purchaser of that, you are taking on some of that risk in regards to the growth of the cash value in that policy. Then you have the last one is index universal life, which is going to kind of map out, it's going to track one of the indexes that are out there, S&P index, the Dow. Some of them even use the Hang Seng, which is international markets. And they're going to look at what those markets did over a period of time. It's 12 months, 24 months, 36 months. In that, they were going to, attribute whatever growth into the account to your cash. So the sell behind that is that those don't have any floor. They have a floor, right? Their cash value will not ever go negative, right? So in there again, right, you have some different things, added protection, I guess, is what you have, added expenses as well. So again, right, if you're trying to make the cash grow, you're going to have to overcome some of those hurdles.
I want to state I'm not hating by any stretch. What the issue that comes in hand with this is that a lot of times these types of products are pitched in a certain way for utilization that there are other options that may be more efficient for clients.
No way. This is the Swiss Army knife of investing.
It is the definition of square peg, round hole.
Okay,
when
listen.
it comes to insurance.
Well, if you're not hating, then I will.
Yeah.
Insurance is not an investment.
Right. How about that?
Wow, it's so direct.
Straight to the point.
Yeah.
Yeah. So we're not. And the thing that I wanted to mention is what I'm saying is, not buy permanent insurance at all. There are purposes and reasons for owning and purchasing permanent insurance, but when it comes to those things you mentioned before, college saving, retirement planning, things like that, that's not the right way to go.
I always use the term, right? You're trying to run as fast as you can, but you're running with weights on. And so I always look at it as
very well.
Yeah.
You don't. He said running.
we all know you walk. And so and so I guess my question to Leo is when do you think that it does make sense?
There's a couple circumstances. If you are looking at an estate tax issue, that tends to be that can play as a factor as helping reduce some estate tax liabilities. If you have a planned death, you're trying to plan a specific amount that you want as a death benefit, either for gifting purposes or for beneficiaries, that it can be utilized for that as well. What else?
State equalization.
Yeah.
If you're in a highly litigious profession.
Yes. Yeah. So if you're in if you're a physician or you're an attorney, and your field, you're dealing with a lot of liability circumstances.
But even then, right, you can look at to other strategies too, like having entities
Sure.
before you even get there. But definitely, that's something where it would make sense.
Yeah, it would make sense. But it's not an investment in those circumstances.
So that's where my hating comes in.
Oh,
right.
okay.
I feel like we go to that solution too quickly.
Yeah.
Right.
Yes.
Right.
Right away.
Right. So
Yeah.
another scenario where I think it might make sense to have permanent is life insurance retirement plan, for example. But after you've maxed out all other retirement
else.
vehicles.
What is that though, James? What is a life insurance retirement plan?
I don't know. What is it, James?
Well, first, I actually have a confession to make.
Here we go.
No, I went to a seminar, a life insurance seminar, while I was in college, my senior year, with a friend, and they explained the features and benefits of cash value life insurance. And I'll admit, it sounded awesome. So they were talking about you can use the cash value for as your emergency fund. You can use it to fund education. You can use that cash value to buy a car. And then later on, once the cash value grows enough, you can use it for retirement. And I thought it was so awesome. One vehicle,
Everything.
everything. Like, who wouldn't want to do this? And then I realized I wasn't as smart as my friend, because he wasn't saying much. But after the seminar, I finally asked, "Hey, what do you think? This is awesome." Yeah, I can do the same thing with my checking account and my Roth IRA and my 401k will work. Oh, okay.
I feel like I have to make a confession because I got into this industry selling life insurance, and it was interesting because I passed a Group 1 test that I studied over the weekend, and I could sell these life insurance policies and be able to offer all these crazy features that, being young and not fully comprehending everything, it sounded like a no-brainer. This is the perfect vehicle for everybody. It solves all your problems. You'll never lose money. I'm helping people save. It just sounded so easy to sell. And it really took some time to actually do some deep diving and actually go and talk with the financial advisor and actually look at all the nuances of these things and to really realize how what we were showing was just some sort of hypothetical illustration that may or may not happen. And I also realized, as talking to other life insurance agents, that what we would show as far as rate of return would be very different than the next guy. And yet we would sell those things up. This is solid gold. And I felt a much more need to go get other licenses to be able to really help people instead of just saying, here's the one product that solves all.
Well, I'm glad that's the way you felt, because right now I feel let down by y'all's confessions. I thought y'all's confessions were going to be like, y'all have permanent insurance policies. That would be the ultimate
Storing
confession.
them. You're like trying to hide them from us. It's like this VUL I've been funding for the last 10 years.
Well,
Surprise.
I was about to, because it was that of a compelling story to me, until finally I got a hold. I was shown an illustration. You would put, a monthly premium amount, and then it shows you if, after 40 years, this is the cash value. And those are big numbers usually. They're not going to show you an illustration with small numbers. And so, you're thinking, oh, that cash value you can use for whatever. And then I don't know why I decided I think it was because the annual premium amount was close to a Roth IRA contribution. And so I think because of that, for some reason, I decided to do just a quick time value of money calculation. If I contributed to a Roth, pretending it's the same amount, the discrepancy in the dollars were so big, meaning I would have way more in my Roth account putting in the same money than the life insurance policy. And I couldn't understand it because I was using the same rate of return. And then finally, you start looking at the illustration, then you see, oh, like Alexis was saying, there's fees. This is a life insurance policy. So there's going to be cost of insurance for them to pay a death benefit. And so over time, as you get older, these fees are going up and it's eroding your return. And I think that's something, it sounds like an easy thing to do. But I don't think most people are actually doing that side-by-side comparison when they're looking at it as an investment.
Okay,
I'm so glad he said that. Hold on. I'm sorry, real quick. I'm just so glad he said that because I'm curious to know, could you still quickly do a time value of money? Could you do that today, right now? On the spot?
Oh,
I mean,
yeah.
Yeah, of course.
Yeah.
That was probably.
I got an app for that.
Yeah, I was gonna say that was probably pre-internet, so he probably did it with an actual calculator.
I think he did it with a calculator.
That sticks with you,
BA2
man.
plus.
I am
How you doing?
computing
Well,
right now.
right? Because I was curious about that, right? So I actually had them run quotes on me today just to kind of get an idea
Oh, wow.
of what, like, just for compelling sake, right? To get an idea.
Dude, just another confession. You want to buy a life insurance policy?
So my wife
It's
definitely
okay.
wants me to buy more life
Oh, there you
insurance,
go.
right? So I kind of just had them run for myself, right? I'm in my early 40s. I did a 20-year term
Give him
policy.
the real age. Give him the real age.
41.
I know what y'all are thinking. No
Early
way,
40s.
40s,
41.
50s.
41 for the record.
It's a range.
I did average health, right? I didn't give myself elite health or negative health, just average health. It was $764.80 for a $500,000 term policy for 20 years. I had a VUL ran, so a VUL policy ran for 20 years. Same thing, $500,000. It's not even 20 years. Actually, the policy, you have to pay this for the rest of your life. It was $4,035 a year for $500,000 in coverage. At the end of 20 years, my cash value in the policy was $65,855. Now, we had these run at pretty conservative rates of return. 6% is the rate of return that the illustration, but it has like a little parentheses where it shows 5.52% net. So they're saying that it's only going to cost 48 basis points on the costs and expenses behind it. But I thought it was also interesting too, just like quickly looked at some of the actual, different fund options in there. They had recommendations on which one to use in order to achieve this. So if you pick the wrong ones, this could go up or it could go down. So there's a lot of assumptions in there on how you choose all these things. And so I don't know what the math is, but I don't know if we can quickly do a time value or.
Well, hold on. Let's do the simple math first. So you said 20 years of paying $4,000 a year.
$4,035.
So 4,000 times 20 is 80,000, right?
Correct.
But there's 65,000 after 20 years.
That's correct.
So I'd have less than what I actually put in.
That's correct.
So is that what happens at a bank? Like, be your own bank, right? Like when you.
Hey, I think he's trying to make a point.
No, but
No,
I have
just
half a
questions. I'm just asking questions.
But I have $500,000 of insurance still, though, James.
Well, yeah. I mean, I think they're great. By the way, I'm back to they're great products. So what?
I don't know where I stand still.
I'm confused.
I want to come back to that, but the question I had for James is okay. I hear what you're saying about the Roth IRA.
Yeah.
But if I make too much money, I can't contribute to a Roth IRA. So that would make the life insurance policy better because it's tax free, right?
Well, you can still do a backdoor Roth.
Can I? I have I have a simple IRA.
Yeah. If you have a 401k, we can roll those over. You can do a backdoor Roth. But another strategy you can do is buy term and invest the difference. Not many people actually would probably do this, but anybody can do this calculation. You get an illustration for permanent cash value life insurance for a specific death benefit. You see the premium. Run another illustration for the same death benefit, but for a term policy, whether it's 10, 20, 30 years. The term and then compare the premiums. The term policy is going to be cheaper. And that difference, do a calculation. If you were to invest it,
I'm glad you said this because
Yeah.
his numbers
Oh,
are right
he
here.
He had already
He
done
is
that.
prepared.
This is where he was going.
Oh, okay, here
I
we
got
go.
this is why he was asking you. I put two and two together. This is why he's asking you if you know how to do a time value money calculation today.
Got it.
Because that's what we're going to do right now.
Okay.
So it would be $4,035 minus $764.80.
Hold on. 4,035 minus what?
$764.80.
I guess I have to do that.
You can do $765 if you want.
Okay, so that's $3,270.20. So
That's the
that'd
difference
be-
in premium.
That's the difference in premium.
Same death benefit.
Same death
okay.
benefit.
All right.
So I would turn around and invest that.
I would recommend so, sir. That would be ideal if we're trying to grow money. Yes.
And for how long are we doing this? You said 20 years earlier, right? Okay.
Well, I think we're going to do it just for 20 years, just for comparison's sake, right? Because on this whole life policy, you got to keep paying that premium until you die.
wait, so that's a whole life policy?
This is a variable universal life policy.
All right, what rate of return? It's got to be apples to apples. What rate of return am I using?
Well, we can use the 6%,
No,
or we can use the 5.52.
you gotta use the net return. 5.52.
5.52? Mm-hmm. Is that even the right rate of return? Right, whatever.
I've never seen a man do this calculation with those kind of socks.
You're welcome.
I like that the phone can do all this.
Okay, so 5.52% per year for 20 years. Is 5.52 hard to get over 20 years? Okay. $3,270 payment per year. That's the difference between the term and the VUL. Nobody? No drum roll?
Okay.
Would give you $120,577.48 after
you-
20 years.
If you were to subtract 65,855 from that, what is the difference?
$54,722.48.
That's a terrible bank.
But that's all taxable, guys.
Very true. So, right, you can take some taxes out of
No,
the
it's-
equation.
That's not all taxable.
If it's
Oh, you're talking about the capital gain.
yeah.
Okay. So
You want
Yes,
to take out
whatever.
15% from that?
From the whole thing?
no.
From what number?
You have to take it off the gain, off the difference between your cost
I mean, you
basis.
could do it that way. I mean, just to see. But even then,
It's irrelevant. It's still way more than what's in there.
Even if you take the taxes into consideration into play.
Are you sure?
do it.
Have y'all done the math?
Do it.
Yes.
You had
Simple
done
math. It's easy.
It's so simple. Can you please use a calculator?
Credo, math in head.
that. Oh, okay. So 54. I already did that. No, I didn't do that. 65,408. That's just happy coincidence. All right. I was kind of joking around about steel manning that this is a good investment, but food for thought. Would it be 5.52? Because you are going to charge a fee to manage those assets, right?
Then you would utilize the same number then on that rate of return.
It's the same gross return.
Yeah, same gross return.
All right. So the capital gain would be about $55,000. 15% of that is about $8,200. So you subtract that out of that 120, right?
Yeah.
So it's left with 112.
112,000.
So is that better or worse than the VUL?
Almost double.
Okay.
What I thought was interesting is if you looked at what the average S&P index return has been over the course of long periods of time, it's 9.5%, right? So here is a plain Jane, right? Something that somebody could do on their own. They didn't have to need an advisor, just buy into the S&P index blindly. And I don't know what the math was, but
I think we did earlier. It was like $175,000.
and that's given a 9.5% rate of return. Now, again, right, that's taking on risk, right, of such a sort. But so I think it kind of goes back to the general question, right? What kind of risk do you want to take?
Okay, but we talked about this, right? Like you gotta the plan,
Practicality.
the policy design has to be right.
Right.
I think the policy needs to match what the individual is trying to acquire or trying to do.
Well, what I'm saying is, we mentioned it earlier, where several scenarios where a permanent life insurance policy might make sense, and one of those being a life insurance retirement plan. If you are going to do that, it has to have the right policy design.
Right.
what is that right policy design, and did you use that right policy design on this?
So on this particular, for a regular policy, or are you talking
For a
about?
life insurance retirement plan, right? Like if you're gonna use the cash value to fund financial goals, there's a certain way that these policies should be designed.
This one was not designed like that. This one was designed just as a blanket of $500,000 straight to it, right, to try to build up cash value. So if we're
So
going
it
to
still might be better.
if we're going to a policy that we wanted to build up cash value, we have zero concern about the death benefit, right? We're looking at trying to max fund a policy. They typically have a 7-year pay up that you can utilize. And so in that process, right, we're trying to just put as much cash into it. The death benefit is almost irrelevant. We want it to be as low as possible to match whatever dollar amount that we're able to put into the policy without it overstepping some guidelines. There's some guidelines that are called MEC. I can't remember the exact acronym that it stands for, but if it does that, it can create some tax issues. And so there's this guideline that you got to stay within. And as that policy, as you keep putting cash in there, that death benefit should be rising to match the amount of cash that you're trying to put into the policy. At some point, though, when you start to take money out, right? So you got to show these that you're actually starting to take money out at somewhere down the road. That death benefit should also be coming down.
Why is that?
Because if the death benefit stays up, going back to James Credo's earlier comment about as you age and as you age, it's more expensive to cover you for insurance purposes, right? As you age, as you get past 60 years old, the cost of insuring you go up and up and up. And if you don't lower that death benefit, it's going to eat into the cash value worse than what you would think it would.
Wait, so are you okay? Well, taking withdrawals also lowers the death benefit, right?
Correct.
So in other words, because there's two ways you can take cash out of the cash value. Right?
Withdrawals and loans.
Withdrawal or loans.
Yeah.
Yeah. So how do those impact the policy?
I mean, both of them affect the death benefit. So you have to have, within these permanent policies, you have to have a certain amount of cash value sustained in the policy to keep the policy in force. So if your cash value gets too low, that it can't sustain your death benefit, then the policy is just going to go away. So if you're taking out too much and you're over distributing or you're over lending against the policy, it could have a huge effect on whether the policy can sustain itself and actually even still stay in force.
And at the basic level, if you are calling it an investment, you're supposed to be reviewing that policy annually or even more because it's an investment. But most people, I mean, he just did a quick calculation. After 20 years, you paid in 80,000 and you get 65, right? And so that's something you're supposed to know every year, like what's happening with the cash value. But I feel like oftentimes people are like, wait, I put in more and I have less money. And so how are you even going to use this to plan for retirement income when you're already having your cash value is already less than what you put in?
Yeah.
know?
Did you ran a term policy? What was the cost of your term policy, you said?
It was 760. Hold on here.
765, something like that. Yeah.
$765 a year.
Yeah. The thing too is that there's not the same versatility that people assume that they have. And really the biggest thing on these policies also, and each one of these policies are so different, the surrender scheduling on these things are all different as well too. And they're so long, anywhere from 7 to 12 years on some of these policies. So you're never going to be able to, if you wanted to, and you're just like, you know what, this stinks. Like this was a terrible idea. I can't believe I joined Credo to that seminar and bought in. This is awful. Thanks a lot.
He was all excited about
But
it.
if you, like 5 years later, you're just like, dude, just give me my money back. Like, whatever. I didn't make anything. Just give it to me. Well, unfortunately, you're still in a 6% surrender schedule. So, you still have a huge amount difference in what you can actually take out and what the actual cash value is.
Does the bank charge you 6% to get your money back?
Yeah. If you're in a CD.
It's just future interest.
Hold on though. Like, all right. You mentioned S&P 500 earlier. Couldn't I invest the VUL in that?
Possibly, right? So each of these different policies will have different options available to you, right? So some of them may allow you to have that option. Some of them may not. They may have their own particular holdings with their own particular expenses. And so there are, like anything, there could be some limitations. Each of these are essentially contracts that you're agreeing to. And so I think it's really important to Credo's mention that you look at all the different options that are available to you before you make a selection. I always find it interesting that here he was, a young 20-year-old, 19-year-old, whatever age he was at the time, looking at a life insurance policy, right? At that point in time, right, they were asking him to make a commitment, right, as you can see, for life, to something that he hadn't even made a commitment to a wife or to a
Wow.
Maybe.
You never know.
I just find that interesting that these things are being sold to individuals that don't even have liabilities, right? They're just being sold as an investment vehicle with that whole one thing fits all kind of deal, instead of actually talking to him and asking him what is he trying to do.
Yeah. Okay. So, but Joe Schmo down the street, you're saying this is going to earn me 6%, but Joe Schmo down the street is telling me his is going to do 8, so I'm going to go with him.
You want me to change the numbers?
What do you mean? How do you change the numbers? What's that number based on?
Well, it's based off whatever we have the inputs on, right? I mean, we can make these illustrations. We can change your net returns to a different number to show a different
So that's
hypothetical.
not guaranteed, is what you're saying?
No, I believe the guaranteed on this one was actually like 2%, or at least that was a fund account that you could have. You could have a guaranteed fixed account at 2%. So they do show you different policies with much lower numbers behind it. This one in particular is showing a 6%, 5.52 net, because they're assuming that since it's a variable policy that you are going to take on some of that risk and buy into some holdings that have stock market like returns.
I think James is making a good point too, because now I'm remembering that every firm that you run that illustration with, the max return that they allow their agents to do is all different.
We used to show 12.
Because at some firms, you'll see the illustration being run at between 6 to 8%. But I think it was just several months ago there was a policy that we saw that they were running it above 10%. So I didn't think you could even do that, but sure enough we found one.
Yeah,
So
I saw one not that long ago that was showing 8% return net, 8% net, and I think that
We saw higher.
I again, right? They're there, right? It's kind of shocking to see that how there's limitations to what each firm can show, and how they're all different, right? And I don't think that consumers understand that, right? They think that when they show these things, those rate of returns that are being shown on these hypotheticals are what they're going to get. And they don't understand that they are truly hypotheticals, and they may vary. But I think, going back to your point, that's interesting is that these are purchased and yet they're not constantly reviewed.
Well, I just wanted to make it abundantly clear that 8% or 6% or whatever is illustrated is based on the performance of the sub-accounts that are chosen, and sub-accounts are essentially like mutual funds. So the more risk you take on, the greater potential return, but the more volatility. You mentioned a floor earlier with IULs. So if you take on more risk in a VUL in the sub-accounts, there's a potential that you're going to lose money.
Don't forget that those higher stock position sub-accounts typically have higher expenses.
Right. Yeah. Right. And so I guess the other point, I think the other takeaway is that if you're going to be, you might illustrate a 6, 8, or 10% return, but then choose really conservative investments in your VUL. So are you going to realistically be able to get that 10 to 12%? So I think that's important for people to know and understand, because that's how I think they're often missold and misrepresented and not fully understood or fully explained.
Yeah. And a lot of times too, they don't historical average rates for return on some of these accounts are not very old. So some of the funds haven't been around for very long. So the last couple of years have been pretty good market wise, but they're selling you a policy that's supposed to last for the rest of your life. So just utilizing the last couple of years rate of return to put together a proposal and basing it off of, well, look what this fund has done over this time frame, let's go off of that, is borderline unethical.
Yeah, I heard y'all say a couple times about lasting the rest of your life, or you made you said about committing to this for the rest of his life. But my kid is going to go to college in 10 years, not at the end of my life. So I don't need it to last the rest of my life. So why isn't this an appropriate? Still not understanding why this is not an appropriate.
It's just not cost effective, because you can buy, let's say your objective was, I just want to make sure I protect my family until his graduation date. So you can probably buy a 10 or 15-year policy. And as Alexis has shown when he ran the quotes, the term policy was that much cheaper. And so now you're going to buy a permanent policy designed to last longer, but you're not going to use it for that long. You're just wasting money. Is what you're doing.
I think there's better vehicles if you're going to be utilizing it for college purposes, right? There's college 529 plans. Though that money does grow tax free to alleviate your tax concerns, because we know how much you love taxes. And so I think the biggest key here is to match up what the client needs or the consumer needs in order to get them what they want to acquire or what they're trying to achieve. I think going to James's point in regards to the death benefit or whatever it is that's being sold, a lot of these liabilities that they may be having of why they need the coverage when they first come to you, a lot of those fade away, right? So in 20 years from now, a lot of individuals may not have that education expense that they were needing to apply for, right? So these whole life policies will be sold to them. Well, we'll just cover all your needs. Well, that may not be needed 20 years from now. You might not need $500,000 of coverage because your child is already in college, has already gone through college, your mortgage has already come down, your liabilities have come down. And so I think trying to match up with what you're trying to do is the most important thing with the consumer.
Yeah, so I don't know if y'all could catch. I was just kind of messing around, just trying to take the other side.
Nope, you're serious.
You're dead serious.
No, but now I'm being dead serious. I hear what you're saying, but if I don't need life insurance, or if I'm really just getting it for the cash value, I don't care what my life insurance needs are.
If you're trying to just grow your money in that aspect, is that what you're asking?
Yeah.
So I think, right, going back to that,
like in other words, I don't care if it runs out or whatever, like, because I have it for the cash value.
Again, I think going back to, there's other vehicles that you could be dwindling off of and drawing off of that will have had higher returns. You'd have more capital to pull off of different vehicles other than life insurance policy. I think in the life insurance policy, you're going to end up having a lot smaller of a bucket to pull from than other potential vehicles.
Ooh, I like the way you worded that. What I was hoping somebody on this panel would say is that whenever you kind of started going there earlier, if you take...
I was rudely interrupted.
Who was it?
I don't know.
Who was it?
More than likely.
Him, right?
Like how you just did that to him too, though.
Well, then finish.
No, I have no idea where you're going.
Oh,
No idea.
no. You were talking about it. You didn't say this word, but this is what you're talking about. If there's not enough cash value in there, the policy could lapse. If the policy lapses, all that stuff becomes taxable.
Oh, yeah.
So then there goes that tax-free out the door, out the window.
Yeah, he was trying to get into modified endowment contracts as well earlier, which then could there's different tax issues that could occur by putting your contract into MEC. Yeah. So I mean, we've looked at it from different perspectives, but when we're going through, and we'll talk about our process a little bit when it comes to insurance, but when we're going through and working with clients and discussing from a planning perspective where insurance makes sense, we're trying to be cost efficient as much as possible. And we know that there's other efficient ways from an investment perspective, other vehicles that we have at our disposal. Even from a lending perspective, there's other vehicles that we have at our disposal that you can actually be your own bank and have some more efficiencies with it, that we want to make sure that we're utilizing the insurance appropriately, because at the end of the day, it's still insurance. And so we have retirement accounts for retirement accounts. We have college savings plans for college savings needs. We have lending instruments for lending. So these life insurance policies are what they are. They're life insurance contracts. And so, understanding when to implement them, if there is a permanent insurance need because of what the goal is for the client, putting a plan together, understanding what the need is, how much insurance we need, how to fund it appropriately. For whatever reason, we get into a scenario where they want to overfund retirement because they've already exhausted all their retirement accounts, doing that appropriately, putting the contract together appropriately, like we discussed earlier. But utilizing everything at our disposal to make sure that we're utilizing the insurance for what it is, and not trying to, like we said, not trying to stick a square peg in a round hole just because. And also, we haven't talked about this. Insurance contracts pay some of the highest commissions in the industry by far. It is one of the most lucrative products in the industry. So that is also one of the biggest reasons we tend to see these types of policies being pushed, because they provide a significant commission premium for the.
Yeah,
Oh, you guys are going there, huh?
I was gonna say, are you looking up your commission statement?
Yeah, it's funny here because my agent look on this one says Leo Chang, and the premium on this one is actually higher than the commission payout is actually higher than the premium. So it is.
Are you serious?
Yeah.
Man,
So-
that just hurts.
So it's like,
I mean,
What company is that?
hey, can you send that to me?
I got the email.
Are we still going to air this podcast?
I don't know. I don't know if it's going to get through compliance.
no names,
The
please.
one thing I really want to, I guess, stress, or I guess just to give you an analogy or framework to think about it is, okay, so you mentioned earlier that you got to make sure that there's enough cash value to carry the policy, right? So some insurance companies will put a max that you can borrow, right? They might say like you can only borrow 80%, right? So imagine if I went to you, I opened up a 529 with you, and 529 is for college savings, and I said, hey, Leo, my son's about to go to college. I need to borrow. I need to take my money out to pay for his college. And you say, okay, here's 80% of your account. Like, you wouldn't be, I wouldn't be too happy about that.
Excuse me?
Right. Like, what do you mean? I thought I was my own
Kinda
bank.
Depends if you're a glass half full or
or a glass 80%. Yeah. No, you know what I mean? Like, I don't know.
I'm just curious too. I've never had to do this, but what does that look like, right? What does it look like? What's that time frame to actually take the money out? Because I feel like most of the time when clients have something, hopefully they give you enough time to where you can actually, you're not pressed.
Taking out the insurance policy?
Sure, right? Because I'm pretty sure
it doesn't take much.
it's a form.
Yeah, it doesn't take
It takes
much.
how long though?
it's gonna.
Like 3 days?
It's gonna be harder on you than it is on the client. Don't worry.
for sure.
Client's okay.
I guess. Well, I get that, right? But I guess 529 account, right? If someone needs the money, it's fairly quickly.
it could take a week though. I mean, I know what you're saying. For different types of investments, you can get it there within 2 to 3 days. Yeah. So
Okay. So life insurance is an investment, not investment?
life insurance is for life insurance.
Ooh, I like it. Okay.
Life insurance. Yeah.
Yeah. All right. You know what? Yeah. Sorry. I'm going to go back to your question about when is it appropriate. You asked Leo that earlier. I think one of the questions I like to ask myself or the client is, do you want life insurance in case you die or for when you die? And if they say, in case I die, that's term. They say, when I die, that's permanent. So I think that can help determine what's appropriate.
Yep. Agree.
Any parting words?
Talk to your agent.
Your agent.
That was Alexis Villarreal, reformed insurance agent. That was our 2 cents on your dollars.